The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome to today's presentation. I apologize for being a couple of minutes late here. I hate being late. Unfortunately, we are having some internet problems. There's some thunderstorms moving in the area, bad timing. So if the internet goes out again, that's one of the drawbacks of doing live presentations is that you are at the mercy of whatever internet connection you have. And my internet connection is fine, but unfortunately, the weather is causing an issue. So if it goes out, I'll try and get it back up. Obviously as soon as possible. If not, then the video will be on the website, and I apologize. So, having said that, we're going to be starting session 2 in Option Insanity. I know y'all are super excited about this approach, and it is a tremendous approach from the standpoint of probabilities. When the opportunities are available, they are some of the best you will ever find. And I realized after doing session 1 that I may have jumped ahead of myself just a little bit because I get excited about sharing this stuff with you guys, and I did a little looking, peeked under the hood a little bit at the buyers of those who got involved with Option Insanity, and a large portion of them have never purchased or attended any other option course that I have. And so you'll have to forgive me. Sometimes I take for granted. I've done so many of these that it is often I forget what I've said in which course, because a lot of the principles can be applied to all the courses. For example, the PPD. Buy cheap PPD options, sell expensive PPD options. Well, that's the backbone of virtually every option spread strategy that I trade. Right? That's the principle behind it. And so there are things that I say with regard to that in certain courses, based on certain strategies that are more relevant for those strategies. And there's certain things that I will say through with Option Insanity that's more relevant to this particular application of that same principle. So what I'm going to do today is I'm going to go back just a little bit and make sure that everybody understands the foundation of this, because my goal in all of these things is never to just say, hey, do this, and don't ask questions. I want you to understand what's going on, and I want you to understand where the opportunities come from. I want you to understand why they exist. When they don't exist, I want you to understand why they don't exist at that point. And so this is kind of the last, this particular approach is kind of the last segment of the entire gamut of PPD approaches. PPD-based approaches. So buying cheap, selling expensive. There's only so many ways you can do that, right? And so this is the one where I'm looking specifically at a certain scenario of when that exists and how to take advantage of that. So while I've entitled this "Finding Opportunities," it's probably a better title is "Understanding the Opportunities." And understanding what's behind the opportunities. And that ultimately will help you find the opportunities. It'll help you to know where to look. It'll help you to know when not to look. So for example, a lot of traders, sometimes they want to make a trade so bad. And some of you on this call know exactly what I'm talking about. You trade because of the action. Right? There's a certain euphoria you get from taking action in anything. And that's certainly true with trading. You get a little dopamine release when you take a risk. And so some traders, unfortunately, that rules them. And so all they want to do is they want to trade. They want to trade. And that's the furthest thing that you want to do. So when the opportunities exist, yes, take them. When they don't exist, don't sit there and try and force something, um, because sometimes they don't exist. And when they don't exist, sometimes other opportunities exist. So having said that, we're gonna make our way through this, and I changed it just a little bit from what was planned because of the current situation. I felt like, you know what, I'm just gonna go ahead and give these guys a bonus today, and so uh, I'm gonna I'm gonna go through the principles and the understanding of what it is that we're trying to do, and then I'm gonna give you a bonus based on the overall principle of what we're going to be discussing today. Now, I do want to make sure that you can see. Okay, perfect. You can. Just want to make sure that you are seeing the right screen. All right. One other thing, I'm going to start the slideshow and it's going to screw it up, but don't worry, it will come back. And let's see here. Yep, okay, perfect. It didn't screw it up. Excellent. One thing of technology, well, there it goes. Let's see. There we go. All right. So we're going to start with kind of going through the basics. As covered in session one, the first two steps of the option insanity approach is number one, we sell further expiration options and we buy nearby expiration options. All right. That is the structure of option insanity. We're selling further away expiration options. That's completely opposite of what most people think of doing, and in the past, it just simply has not been available. It's only with the Monday, Wednesday, Wednesday, Friday, and Friday, Monday relationships that this becomes available from the standpoint of being able to sell a further option expiration and buy a nearby expiration option, and achieving number two, which is to sell expensive PPD options and buy cheap PPD options. All right, so we have to have those two combined elements in order to have an option insanity trade. Those two combined elements have to exist. Sometimes they don't exist. They exist a lot more now because of the Monday, Wednesday, Wednesday, Friday, Friday, Monday option relationship. It almost never existed before when there was only Friday, Friday. And it absolutely never existed when it was only monthly options. And so this is a new phenomenon that has not existed in the past prior to Monday, Wednesday, and Friday options in SPY. And because it's the only market that trades, it is in SPY on Monday, Wednesday, and Friday, and of course SPX as well. But you can do this in XPX as well. Nonetheless, because of that, it's only available in SPY. It's not available in any other market just yet. And eventually, you're going to see this extend to Monday, Tuesday, Wednesday, Thursday, and Friday option expirations. We're probably a year away from adding another day, maybe a couple of years away, but eventually they're coming. You know it, I know it. It's just a matter of time. They're going to have daily options in SPY. And so when that comes, obviously you're going to want to understand how this works and what to look for, and what not to look for. And you're going to be able to see that there's our cheap, expensive PPD options with further expiration. Let's say a Wednesday, it's going to be more expensive PPD than on a Tuesday. Let's say it's Monday, and that very well may be the scenario that we run into. Is you'll be able to sell Wednesday and buy Tuesday, and create an option insanity approach. All right, but you have to have the expensive PPD options in the further expiration and the cheap one in the nearby. So sometimes expensive PPD is in the nearby expiration options, and sometimes expensive PPD is in the further expiration options. That's why you're not going to have 3 trades every single week. You'll usually have at least 1. You'll often have 2, and on occasion, on a rare occasion, you might have 3. meaning you do the Monday and Wednesday, then you do the Wednesday, Friday, then you do the Friday and Monday. All right, that would be 3 opportunities every week. Um, most of the opportunities, I can already tell you just from experience, are going to come on Friday, Monday. Okay, Friday, Monday, you're going to see the option insanity approach best executed during those 2 days. Now, having said that, this week is different. All right, as you'll see. So last week it was a great opportunity. Tremendous, tremendous trades were taken last week. This week's things have switched, and I'll get into why that happens and all of that here in a minute. But option insanity again is when the further expiration PPD is expensive compared to the nearby PPD expiration. When that does not exist, there is no trade. It's as simple as that. You don't even need to look for an option insanity trade. And I'm going to give you the telltale signs. Like I said, we're going to talk about finding the trades. And there's a telltale sign, a very easy sign that you'll be able to look at and say, okay, yeah, this is a good time. There might be some option insanity opportunities. Okay, really simple, really easy, and I'll show you that here in a minute. Nonetheless, so option insanity is where we sell further expiration, buy nearby. There are strategies where the expensive PPD is in the nearby expiration options and the cheap PPD is in the further expiration options. And in fact, that is normally the case when you're looking at relationships outside of Monday, Wednesday, Wednesday, Friday, and Friday, Monday. Okay, it's normal. So a Monday, let's say a Monday, Friday, a Wednesday, Monday, a Friday, Wednesday, those things, most likely it's going to be the reverse. And there are strategies that I use for these scenarios. So number one is cash flow option spreads. If you're not a member of cash flow option spreads, man, you are missing out. That is my favorite option strategy that exists with other markets outside of SPY. Okay, you can actually trade cash flow option spreads with SPY as well, but this is my favorite one outside of SPY, and it does a tremendous job of selling the expensive PPD and buying the cheap PPD consistently. All right, so and by the way, I would strongly, strongly, strongly suggest um, any trader, every trader, as a matter of fact, to not focus on just one strategy, but rather to focus on multiple strategies. Take one trade from this strategy, take one trade from that strategy once a week, and get to understand how this stuff works. And that's the way you'll do it. All right. So there's cash flow option spreads and then risk-free projection spreads. Man, that is a close, close second. In fact, you're going to see, I told you I was going to give you a bonus today. I'm going to give you a trade that I took today based on the risk-free projection approach, kind of. It's a little bit different, but nonetheless, it's based on the expensive PPD options being on the nearby expiration and the cheaper PPD options being on the further away. And I trade this one mainly in SPY. So risk-free projection spreads are traded mainly in SPY. It's a little bit more complicated most of the time. Today's was not. It's a little bit more complex, but nonetheless, it is, again, it's something that if you know what to look for, you go, okay, this is a risk-free projection opportunity, or it's an option insanity. You rarely have both existing at the same time with the same expirations, and certainly not the same strikes, right? So obviously you can't have both because you would have a 50-50 probability, all right? So that is what I would strongly, strongly suggest that you look into if you are not members of those two. It will absolutely help round out your ability to really take advantage of the markets. And to be really successful, you have to be able to determine the market conditions, i.e., where's the expensive PPD options and where's the cheap PPD options, because that means that you can take advantage of whatever market conditions exist. All right. Sometimes you have neither. Sometimes it's kind of an equal scenario. And in those times, by the way, I favor the option insanity. And I'll talk about that here in a second. Nonetheless, when you have an expensive PPD and you have a cheap PPD, that does not necessarily equal a great trading opportunity. Okay, I can show you many, many expensive PPD options and spreads with cheap option legs, and the probabilities are you know, yeah, it might be 55% probability with a 1.3 win-loss ratio. Yeah, that's okay. It's going to take a long time to build from that standpoint, but it's okay. Um, and then there's some where it's just flat out 50-50 type stuff. And the reason is because why? And if you've attended my risk-free projection course, you know why. And the reason is that expensive PPD and cheap PPD they are not the only factors that create profitable opportunities. What's another factor that creates a profitable opportunity besides time decay, right? And that's what we're doing, right? We're trying to create a situation where we're taking advantage of time decay with as little risk as possible with these spreads. That's what all of these PPD-based option spreads are based on. However, there's one other thing, and that one other thing is market movement, right? So if the market moves far enough, it can cancel out the PPD probability that you have in your favor. And so what you're looking for is you're looking for a probability that the market's not going to move outside of the profit range. And then you combine that with the win-loss ratio, and that gives you your total overall probabilities, right? So most of the time, combinations, the risk-reward metrics, are simply not skewed enough for a trade. So that's why you can't just randomly throw um, uh, various combinations together and expect to make money. Most of the time, you're going to break even, lose a little bit, make a little bit. You can't just randomly throw this stuff together. And one thing that option traders don't realize is that the most of the time the probabilities are ever so slightly in your favor, or ever so slightly out of your favor. There are reasons why these options are priced where they're priced. This is not there's no free lunch. They're trying these options are pricing everything in order to make sure that there's no free lunch. You have to find them. You have to know where to look, and you have to find them based on that, and then you have to use proper money management. So you don't think that you can just willy-nilly these option trades together and it's as easy as 1, 2, 3. It's not. You have to follow these principles. You have to realize where the opportunities exist and why they exist. And then sometimes news events and upcoming economic reports can skew the current projections from the future reality of PPD. So in other words, what you may see today may not exist tomorrow. And what you see tomorrow may not exist the following day. And unfortunately, most of the models cannot take these things into account. So for example, last week and the first Friday of every month, there's an issue that we have to deal with as an option trader. And you see this borne out. And one of the things that I do is I collect option data. And I can see the average price of an at-the-money call option in SPY over the last 7 years, right? And I can tell you, so on a Friday, or excuse me, let's say it's 5 days away on a Friday, I can tell you what the average price of a 5-day option that expires on Friday that's at the money is over the last 7 years. And so what you'll find is that the Friday options on the very first Friday of the month, almost every single time, is more expensive than any other Friday of that month, except when there happens to be something really big that's propping up the option prices, like a news event, summit, the FOMC meetings, et cetera, right? So you've got unemployment that comes out on Friday, and so it props it up. As soon as that unemployment report comes out, the volatility tanks. So Friday morning, 8:30 a.m., that report comes out, market makes a move, settles down within the first hour, and from that point on, the option volatility tanks in the Friday option and in the Monday option. And so you have to deal with that. And so sometimes these news events or these upcoming economic reports can skew the current projections. We saw that. That's what we saw last week. We saw the Monday uh, options being elevated because of um, trade talks, some trade announcements, and then the prior to that, you had the unemployment report. This week on Thursday, you've got several reports coming out, and then there's also I think there's comments this morning about possible lowering of interest rates. You get the idea, right? So there are things that prop these things up, and then when those things pass, you almost always see volatility crash in the markets. All right. So unless there's some massively unexpected result from these, and the market just goes crazy, but that's not the norm. The norm is that the volatility crashes, and so you have to also plan that into place. Okay. So with that as the backdrop and with that as the context of what we're trying to do, I'm going to show you a chart, and this kind of gives you a picture of what we're looking at. This is a chart of price differences between expirations, and this is available in Trade Partner, by the way. And so with this particular chart, what you see is the 710 expiration, the 712 expiration, and the 715 expiration. And when this was taken, the blue is 1 day away, one full trading day. The red is 3 full trading days, and the green is 6 days, but it's not 6 trading days because that's a weekend. The green is a Friday, or excuse me, a Monday, and 2 of those are not trading days. And so with that, you actually have 2 less trading days than the 6. So you actually only have 4 trading days with that, but it is 6 days away. And so what you'll see is this difference in prices. And when there's a skew in these prices, when there is a gap, that's where you can look at and you can say, okay, there probably is an option insanity approach between the blue and the red. And there's probably not an option insanity approach between the red and the green. Okay. And the reason is because of the price difference in the options. If the price difference is very small, then what you have is a scenario where the expensive PPD is on the nearby option and the cheaper PPD is on the further option. All right, so if you take a look at the red and the green line on here, you have a price difference between these options at the same strikes very small, which means that the PPD is going to be higher on the red than it is the green. However, if you look at the blue, you have a much bigger price gap between the blue and the red, which means that it's possible that the PPD, the expensive PPD, is going to be on the red and the cheap PPD is going to be on the blue. And so it's when you see these gaps, so this is the first telltale sign that there might be an option insanity opportunity. is when you see this gap between the blue and the red, or between two of the expirations. And where you don't see the gap, that's where a normal PPD type strategy can be considered. All right, so hopefully everybody understands that and everybody can see that. It kind of gives you a visual idea of why an option insanity opportunity exists and why it might not exist. Now, a couple of days ago, the difference between the blue and the red was very similar to the red and the green. Okay, it was very, very similar. It was only after some announcement came out that this particular one dropped. And so, fortunately, with Trade Partner, you can go out and you can look at all the expirations, and you can see that the normal is for there to be some closer gaps in between. And then what happens is you're actually looking for the bottom one, which is always going to be the nearby. So you're while the PPD may be different, right? The PPD may be more expensive on further expiration option. The actual price will never be higher. And so what you have is you have a natural understanding here with this graph of which options are further expiration. The more expensive options are the further expiration every single time. And so you can see the gap between each following expiration. So the blue is the red is the Wednesday, Friday, red, brown, Friday, Monday, brown, green, Monday, Wednesday. And then the green, and then I don't know what color that is. Kind of a between a green and orange. So you can just follow it along and you can see that, right? Well, what happens is almost every single time, what you're going to see is you're going to see the next option expiration begin to separate itself from the further option expiration. All right. So tomorrow, you're probably going to see a bigger gap, especially since there are a couple of announcements coming out. You're going to see a gap begin to increase between the red and the brown option expiration, which is Friday, Monday. And all of them will move down to some degree. Okay, all of them, because time will have passed. So unless the market, when I say down, I mean in relation to one another. So unless the market tanks tomorrow, for example, which will always increase volatility in these options in SPY every single time, then you're going to see the prices come down for the at the money option, for example, or the in the money option by 1 point. If the market tanks, you actually may see an in the money option by 1 point be more expensive than the in the money option today at 1 point. In other words, let's say today 298, the 1 point in the money option is 297. All right, and let's say it's priced at 130. Well, tomorrow, if the market tanks to 285, the 284 option is probably going to be trading for about 170, 180. It actually be higher priced than today's 1 point in the money option. And that's how I track these option prices, by the way, is their relationship to being at the money, in the money, et cetera, out of the money. And you'll see this all, every time the market begins to move down, the volatility goes up as the market moves up. And I'm speaking only of SPY or stock index markets. If the market goes up, you generally see volatility begin to drop. And so that'll especially happen if SPY is up again tomorrow. Then you'll see these option values drop a little bit more. All right, so the tendency being as it draws closer to expiration, it increases the gap. Okay, this is why, for example, why cash flow option spreads works. If you know anything about cash flow option spreads, we sell the nearby and we buy a way further expiration. And the purpose being that we're going to sell multiple expirations with that, right? So that's what you can expect, and that's when the option insanity opportunities begin to exist. Is when you see these gaps begin to widen. Okay, this is what sets up an option insanity trade, and that's why these are relatively short term, 2 or 3 days max, as a general rule. Sometimes you can get a little bit better, a little bit longer, but not often. Most of the time, it's 2 or 3 days max. And it begins to occur as you see a separation in the gap. And the separation is not because of the further expiration option becoming more expensive, as a general rule. It's because the PPD on the nearby option is beginning to drop. Okay, with regard to let's say out of the money options, in the money options especially. And so you may have almost no extrinsic value in a 2-point in the money option, for example. And that was the case a couple of weeks ago. There's almost no extrinsic value in a 2-point in the money option. And so we bought that option. And then there's a lot of extrinsic value in the at the money option that was further away. And so we sold that one, and that created the option insanity trade. And that's what sets these up. Okay. Now, another way to look at this is looking at Friday, Monday calendar spreads. Okay, this is the same thing as this, only in a slightly different way. All right, so we can see that each of these are calendar spreads, basically, if you look along the same horizontal line. So 297.50 call, for example, is going to be priced at whatever it is priced at. Say that's $1. And then the 297.50 call that expires on 7/12, that's going to be priced at $1.50. And so you have this calendar spread here, right? And so each of these are basically calendar spreads. You're looking at the difference in price that would create a calendar spread. So if you look at the risk projection graph of a calendar spread, and specifically I'm going to look at Friday, Monday for today's example, because this is an example of why an option insanity opportunity, as of right now, it may change tomorrow, but as of right now, it does not exist. And the reason it does not exist is because there is no gap yet between the Friday, Monday option prices. That gap is very small. All right, and so by creating a Friday, Monday calendar spread, and this is a 298, so basically I'm selling a Friday 298 call, and I'm buying a Monday 298 call, and I'm creating a calendar spread, and I can do that for a debit of 16 cents. Okay, and what that means is that no matter what, I cannot lose more than $16 on this particular calendar spread. A lot of you are saying, "Wow, that's a great trade." Yeah, it may seem like a great trade if the market's trading at 298, but it's not that great of a trade. And I'll show you why. And again, I'm tying all of this in based on things that I've said in this lesson. All right, so this is a calendar spread. If there's a debit of 16 cents, it's probably not there's probably not going to be an option insanity opportunity. That's just the way it is. Okay, now don't get me wrong, that doesn't mean I'm going to trade this trade, and the reason I'm not is because this is not an accurate reflection of what it's going to be on Friday. All right, there is something propping these options up, and that something is news events, economic reports. Some coming out Thursday morning. There's announcements with talking about the rate cuts, et cetera, et cetera. When all of that's done, this is what this calendar spread is actually going to look like. So the red is based on the current projection. Okay, and that was as of yesterday, I believe. So the red is based on the current projection. The yellow is more likely the maximum that you can expect, and in reality, because of the fact that the volatility is going to drop, it's probably closer to the purple, if you will, or plum, or whatever color that is at the bottom here. All right, and so the projection now is that you can make almost $100 with this thing. Um, in reality, the best case scenario, because of what's propping up the options, that is not worked into the projection model. Okay, some projection models do a better job than others, but news events are generally not worked into projection models. These are math-based models. And how do you create a math-based model that says, okay, there's an unemployment report coming out Friday, and that unemployment report, as soon as that comes out, then the unknown is going to be known, and down comes volatility. And by the way, that's what creates volatility. The market doesn't like unknown. A great example is the last presidential election, in that everybody was thinking that Hillary Clinton was going to win, and the market was betting on Hillary Clinton winning, and it was pretty stable until things started to look like Trump was going to win. And I'm telling you, when you're watching that, the market absolutely tanked, because now all the polls, everybody thought Hillary's going to win, and now you've got a scenario where, that might not be the case. We don't know what that means. And so you see this unexpectation. We don't know whether that's going to happen or not. We haven't planned for it. Market absolutely craters. When it's final and he is elected, markets came right back up within hours. And so you see that volatility based on unexpected events and unknown things occurring. And so same thing on a micro scale with these news events and reports, is that you see the unknown become known. Even if the market makes a significant move, you often see volatility drop because the unknown is now known. And so you have the reaction, then things calm down, and what you'll see in this case is, if it's being propped up by an economic report that's coming out on Thursday morning, you'll see this drop Thursday, and you'll see some option insanity opportunities occur on Thursday. If it's waiting for something else, then whatever that is, but you'll know, right? Because as soon as it happens, that's what's going to happen with volatility, is it will drop. Okay, so come Friday, this thing may actually crater to the point, by the close of Friday, there is nothing else going on, unless something happens between now and Friday to inject more volatility into the market. But barring that, this thing is going to tank. And so the profit potential at best is probably going to be about 50 bucks. And so you're risking $16 to make $50. The break-even point is actually about a point and a half, maybe not even a point and a half, but maybe a point to point and a half above and below the strike of that calendar. And it's just not as good of a scenario. However, that doesn't mean that there aren't other scenarios. And it doesn't mean that when this does happen, if it happens tomorrow, that even though option insanity opportunities don't exist right now, they very well may exist tomorrow and the following day. And so that's how you know when to look for it, what to look for, and whatnot. So why are these calendar spread more realistic projections as opposed to what they're projecting right now? Well, the reason is because of the economic reports skewing the projections right now, and the failure to project reality in the future. Okay, it's a failure to project reality in the future. That's the issue, and mathematical models have a very difficult time doing that. So very important for you to keep that in mind when you're looking at the current option scenario and you're saying, okay, there should be some normal PPD option spread trading opportunities available because this is the landscape. Or take a look at the landscape and you'll say, okay, there should be some option insanity opportunities available. And they often flip flop week in, week out. And so it's not difficult to determine these. It's just a matter of making yourself familiar with them. All right. So if you can get a reverse, for example, ATM calendar spread, which would be a beginning of an option insanity trade. If you can get a reverse ATM calendar spread for a Friday, Monday expiration at a 30-cent credit or higher, and I'm giving you a hard number here based on history of Friday, Monday, which is not long, but it's long enough to be able um, to create a normal expectation. But if you can get a Friday expiration at a 30-cent credit or higher, that is a sure sign that other option insanity trades are available. Okay, instead of being 15-cent difference between the at the money calls, you have a 30-cent difference between the at the money calls. That's a sign that the other option insanity trades are available. And this is what the reverse ATM Friday Monday calendar spread at a credit of 30 looks like. It is one where the maximum loss is about 50 bucks, and you're going to make $30 if the market tanks, or you'll make $30 if the market skyrockets to the upside. And the break-even point is going to be about a point, maybe slightly more to the right and to the left, or to the upside or to the downside. If as long as it moves more than a point to the upside or to the downside, and volatility is not infused into the markets, you're probably going to make money on this. Okay. The probability is somewhere around 55% that you'll actually make something on this trade. The average win versus the average loss is going to be very, very close. Most of the time, you're not going to see the market move down far enough to create the $30 profit. Most of the time, you're not going to see the market move up far enough to create the $30 profit in just 2 days or 3 days, which is what this would be if it were placed on a Tuesday afternoon or a Wednesday morning, right? So, in the closer you are, the lower the probability the market will make the move to actually make that. So this is not, again, not a trade that I would absolutely take because the odds are not great. They are slightly favorable if you can get the 30-cent or better credit. But again, it's merely an indication that other combinations exist. And if you look at session one, you can look at the different strike prices and see where the opportunities actually existed. So this you cannot get. You could not get, at least as of up to this lesson, the live presentation of this lesson. This was not available. It was at 16 cents and not 30 cents, 16 cents. So 30 would be the minimum. If you can get better than that, obviously, it's even better. So, and again, this might be even better than what it looks if volatility, absolutely craters on Friday the way I think it will. But nonetheless, the fact that the option prices between Friday and Monday are so close, that means that there's actually opportunities that exist with the normal PPD type strategies. So the expensive PPD is in the Friday options right now, and the cheaper PPD is in the Monday options. Even if volatility crashes, that's what exists, or at least it existed earlier today. And so this is kind of where I'm veering off just a little bit, and I'm not gonna go into more option insanity opportunities just yet. We'll cover more of those in lesson 3, but instead I'm going to veer off to give you a wider scope of why you don't need to spend hours at in front of PDS Trader trying to find an option insanity trade that doesn't exist right now. All right, and instead, when you have the situation, the landscape being that it is, you know instead to look at the reverse, which would be to sell the Friday and buy the Monday. All right, and so this is an actual trade that I placed today, actual fills, and it's because, why did I place this trade? It's because I understood and understand the relationship between the PPD values, even with the even knowing that volatility is going to drop. Okay, now what's interesting about this trade is that you'll see the exact, or not exact, I should say, similar setup in the option insanity when the PPD values are reversed. You'll see this this double loop, if you will, or this double peak. It looks like a couple of mountains with a valley in between, and you'll see this very similar setup with a lot of option insanity opportunities. And sometimes it'll be a little bit different, maybe reverse, inverse, and so those peaks would actually be closer to the zero line, which is what was in lesson one. But you can also see this, a similar scenario when the PPDs are reversed by selling the further expiration and buying the nearby expiration. Okay, so in case you're wondering whether you're reading this right, I'm trading a bigger trade size on this, obviously. The profit potential shows to be about $1,000 at 297. It might hit $1,000 at 297. It shows to be about $1,000 again at 300. Probably not going to hit $1,000. If the market moves up to 300, it's probably going to be something less than 300, or excuse me, 1,000. In the dip, this is what I call the dead zone in these types of trades. The dead zone shows a profit potential of almost 500, right at 298.50. Not going to happen. It's probably going to be. I'll be happy if the market's trading at 298.50 on Friday. I'll be happy if I get $250 out of this trade. All right. So now, if the market tanks, no matter what, I make money. The credit here is it's $137. So my minimum gain, if the market tanks, I make $137. My only risk here is to the upside, and that is to the upside around starts at around 302, intensifies at around 303. The projection is only about $40. It's actually probably closer to 150. But there's something I'll do to take care of that as well. But nonetheless, you're probably like, wow, what is this trade? And this is only because of the PPD situation. This exists only because of the PPD landscape right now. If it was reversed, like last week, I show you a trade where an option insanity opportunity occurs, and you have almost no risk in that trade. And this week it's reversed so much that you have almost no risk in this trade. And so here's the base. Okay, I started with this, and when I realized that the option PPDs were so close, or specifically the option prices were so close that the PPD for the short term was significantly greater over the PPD for the longer term, that the maximum risk on a single spread of this, exactly what you see here, selling one 297 call, selling one 300 call, and then buying two, it's a butterfly, buying two 298.50 calls for a debit of 6. Again, this is actual fills. This is an actual trade, okay? No matter what, I cannot lose more than $6 to the downside. No matter what, I cannot lose more than $6 to the upside if this is all I did. However, because understanding the relationships between these options and the PPD values and what happens when you move the strikes and et cetera, et cetera, et cetera. Again, it's just a matter of exposure. you can manipulate. You can begin to manipulate and create a scenario where there is no risk to the downside, or you can create a scenario where there is no risk to the upside. Either or you can create a risk-free trade and then plan on, or a risk-free projection trade, or very close to a risk-free projection trade, and then plan on hedging it in some way if there's an adverse move. So um, this was available today. It probably will not be available tomorrow. It might be, but I doubt it. But this is what you can look for. Just as kind of giving you a bonus here. This is what you can look for when the situation is reversed and you see close PPD values. Now, worst case scenario, I've got volatility. I've already projected in volatility kind of dropping here. All right, so this might be fairly accurate, even if volatility drops. But if volatility really tanks, then and the market's trading right at 298, then I might make a couple of bucks. All right. If the market moves up, then my break even might be at 302 and not 302.50. If the market moves down, most likely my break even will remain there because volatility increases. And so as the market moves down, and so that probably will be a little bit further to the downside. But that is, again, that's the value of understanding PPD values. All right. So again, this is the trade, and it's just a slight variation of the base trade. All right. So I sold 20 Friday 297 calls, sold 20 Friday 300 calls. And instead of buying 40 298.50 calls, I bought 36 298.50 calls and bought 5 300 calls, creating a credit to the downside. And I am long one extra call. Okay. And I can do that because of how much I'm able to bring in on the short side. All right. So this one extra call means that I have a weighted spread. And I didn't make this trade all at once. I put on the base trade and then I skewed it with a smaller trade is basically what I did. And I used Trade Partner to do it. To kind of give you an idea. But essentially, what you do is you have a ratio. So you buy 5 of the calls, and then in PDS trade, or excuse me, in Trade Partner, you buy 5 of the calls, and then immediately when those are filled, you place on the ratio of the other 3 legs, and that's how you get filled. If you put this whole trade together at once, it'll just sit there, and they have trouble filling orders like this. So just kind of give you an idea. All right, so that's kind of where I wanted to veer, give you a little bonus of what to look for when an option insanity opportunity doesn't exist. Then ask yourself the question: what about the reverse opportunity? Are there any reverse opportunities? And if this were, by the way, if this were a debit of much more than 6, if it were a debit of 15, I'd be very careful with this trade, because at that point you are creating some risk in the middle section, and obviously you have a risk that is not $6 but $15. That's well more than 2 times the risk, and so if you go with any kind of serious trade size, you're going to have 2 times the amount of risk. So this just happens to be a scenario that, again, doesn't exist always at this small of a debit, but because of the situation this week and what's going on to prop those Friday options up this late in the week, it provides the opportunity. So again, that's what's available when you understand. That's why I took the time today to make sure that everybody has a solid foundation, so that as we move forward and I start to put these things together and show you how to put these things together, you'll understand why I'm doing it and why I would take some trades and why I wouldn't take other trades. And we'll just build on what I provided today. All right. All right. Well, it's already been an hour. Where does time go? If you have any questions, I'll go ahead and take questions. Let's see here. All right. If there are questions in the future, where can I get the answers? So send them to support. They'll forward them to me. I'll include them in sessions or videos that I'll upload. That's how I deal with that. Because I can't obviously talk to everybody. Unfortunately, I had to stop responding to emails several years ago because I would do nothing else if that were the case. Is slide deck available for download? Yes, it will be available for download. All you have to do is look on the Option Insanity section of PDS Trader, and it will be there probably sometime tomorrow, along with this recorded video. Let's see here. Answered that question. Let's see here. Mark, so what I'm doing with, for example, the 1-2 Super Punch is I'm just giving people, or the D90s, I'm giving trades that are available. So those will change, believe me. Though there will not be Option Insanity trades in those D90 programs. Let's see, metrics. All right, so do I think these kind of metrics will last? All right, well, today I think, and it looks like when you asked that question, it was earlier on. What I'm trying to convey today is that the metrics constantly change. The landscape constantly changes. And so sometimes, that's why I said sometimes there'll be a Monday, Wednesday option expiration. Sometimes there'll be Wednesday, Friday. I took some great Wednesday, Friday a couple of weeks ago. Didn't exist this week. As a general rule, there's some that actually existed today. Literally last a day, and the risk was not worth it taking, so it didn't exist. So the landscape is constantly changing, but it's almost always skewed to one side or the other, right? And so it'll go back and forth. Sometimes it'll be evenly matched. Sometimes it's skewed to the nearby. Sometimes it's skewed to the further. And that's why you have to learn the landscape. When it's skewed to the further, the Option Insanity trades are some of the best that you'll find, even better than this basic trade that I placed today. The only difference, the only thing that gives the trade that I showed you today as a bonus is the fact that there's no fourth leg needed to cover the margin, and the cost of this trade literally is $6. So that's the one big benefit when these types of opportunities exist. All right, so it's not a matter of the metrics persisting. It's just a matter of what landscape exists right now, and that's constantly moving and flowing. But there's only three that are possible. Either an Option Insanity opportunity exists, a regular opportunity exists, or no opportunity exists. And it's one of the three, and it goes back and forth through those three. And oftentimes, what happens is through the life cycle of a relationship, you might have, okay, a regular one exists today, tomorrow an Option Insanity trade exists, which means that the regular one became profitable, or vice versa. All right, let's see here. Margin requirements are based on wherever the long is. So if you'll look at the reports, you'll see in some of the explanations, you'll see that there has to be a fourth leg. And that fourth leg is to deal with margin. And what you do is you go as close, and this is covered in another session, but you go as close to the market as you possibly can and not pay anything. It's just the cost of doing business. And so often it's going to be about 600 bucks. Sometimes it's a little more. Sometimes you get it for a little less, depending on the exact setup that you trade. And you'll see there are various different ways to set an option insanity trade up as we move forward. So it's going to be generally between $600 and $1,000 for a margin on these things, which, by the way, in a $5,000 account, you're only going to start with one anyway. So you're going to start with one, and then you're going to go to two, and then you're going to go to three, and it might slow you down from a compounding standpoint. You know, if it's 5,000, the most you can place on is five. If it's $1,000 margin, most you can place on is five of these spreads, right? And basically, the compounding, if it were strictly based on risk, you can compound with a delta of about $100, $150 conservatively. Again, based on the basic application. So I don't want to get too far into that because this is all covered in additional lessons, but it's about $1,000 or less. If you get with a little bit more complex one, it can be a little bit more. Again, plenty low enough to trade, start trading in a $5,000 account. Again, if it's $1,000, you can trade in a $1,000 account. That does not mean that the risk is $1,000. I want to make very clear. It's just simply because the brokers charge you full margin. If you're short a further expiration and long a close expiration, they charge you full margin because they're going to assume that you're going to be naked that short expiration when the long expires. And they make that assumption from the beginning. They don't make it on Friday afternoon or Wednesday afternoon or Monday afternoon or whatever. They make it from the beginning. And so you have to deal with that as cost of doing business with this type of trade. All right. Let's see here. The PDS trader, I had one glitch on the trade finder. I'm hoping they will have that hindered getting the best trades for this. They should have that fixed in the next day or so, and so that'll be up, and everybody will be alerted in the Option Insanity alerts when that's up with a video and instructions. Yes, the link will be the link to this recording will be available in the updates on PDS Trader tomorrow. Reverse ATM calendar spread is when you sell the further expiration and buy the nearby expiration. Couldn't you make an adjustment like buy a fly at 303? Tony, yes, absolutely. Do you place trades prior to market open or during market hours? Both. So fortunately, Trade Partner allows me to do both. Unfortunately, what happens is, so a lot of times the overnight signals. This is why I don't like the end of day signals, but we have no choice. But by the time the market opens, it's vastly different than where it was when it closed, and the opportunities are different. The strikes are different. Everything's different, and that's often, and it's a pain in the rear. So I like to look at what's going on right before they open, and then start planning it out, and then create my Trade Partner file so I don't have to sit there and watch it. When and how do you exit this butterfly trade? It'll be exited on Friday, or I can put a target, place a target on it, and just exit the whole thing on Friday. Let's see here. Yes, the slides will be available for download when the video is uploaded. So yeah, it'll be recording tomorrow. How much margin on the 2020 36.5 trade? Um, I I believe it was, I want to say, man, I don't recall when I looked at it. With the normal, it's a $6 limit, right? Um, with the other one, it's actually a weighted, and so the $6 limit is a little bit smaller. But what happens is you have a difference between the strikes of the shorts. So short 20 here. Let me go back to that real quick. Whoops. All right. So short 20, short 20. The strike difference between the 297 and 298.50 is exactly a buck 50, right? Well, on four of them, it's actually $3, and so you're actually charged margin on four. So it's like 1,200 plus the six is what it would be on the rest of them. Okay, that's how you figure that. All right, let's see here. Moving on, scrolling down. Whoops. A lot of these I've already answered, so I'm just scrolling here. What is my process to comparing the PPD values? I actually begin with that chart that I showed you on Trade Partner. That's the easiest way to be able to see, where things are at, what the landscape is. That one, it's quick, it's easy. So what happens is there's a huge upswing in the market after your buys expire, but before your sells expired. You never hold. You do not hold the sells past the buys. When you exit on an option as insanity trade, you exit the sells at the same time you exit the buys. So it's placed on as a spread, it exits as a spread. All right, let's see here. All right, so here's a question. What's the reason for the buck 50 ITM and OTM selections? Option Insanity has suggested 2 ITM and OTM to start. No, that is one possible selection. All right, a 2-to-1 ratio. You see that in the report. I haven't covered those yet in this because we really need to get to, we really needed to get the foundation really laid before we get to the different structures. Because so the first structure is that there's not going to be any weight, and that's going to be covered in session 3. The second structure is that there's going to be weighted. We're going to weight those things. So I briefly covered the no weight, the unweighted spreads, if you will, in session 1, and we'll move further into that in session 3. But in the trade reports, you'll see that sometimes I do weight these trades, and so again, that'll be covered. Let's see. This sounds more complex than scalping. um, you have an issue with probabilities in scalping. This is not that complex. In scalping, how many times you watch in the market during the day? For example, I placed on a trade last week, an option Insanity, and I just sat there and let it work. I mean, go play golf. This is not complex. At the beginning, when you're learning, sure, I can understand that, but I promise you, the more you expose yourself to these principles, the more the light's going to click on. We're just beginning in the Option Insanity course. Believe me, it's not that difficult. I mean, how difficult is this trade that I just showed you? It's not that difficult. You start with a base and then you manipulate it. You just got to know how to manipulate it. And once you learn that, it becomes a lot easier. But I'm not going to do anything with this thing, Right? I'm just going to hold it, have a target in and hold it. So, all right, let's see. Barry, these trainings will be held until I feel like I have absolutely covered every aspect of this for everyone. And so part of the benefit of you being able to attend live session is that you get to say, hey, I appreciate what you explained, but I didn't understand this part of it. And so can you go over that? And so, I create the lessons to better expand on some of those questions. Can these multi-leg options be easily executed in IB? Yes. You can. It's very easy to put the orders together in Interactive Brokers. I made this exact trade, in Interactive Brokers. I just didn't have the benefit of Trade Partner yet. We're working on hooking up Trade Partner to IB, but yeah, very, very simple. For the option insanity situation, does a major increase in volatility after, let's see, after major increase in volatility after placing the trade cause problems. So last week we had a major increase in volatility based on a move down, and I still made a little bit of money. That's the benefit of when an option insanity approach or opportunity occurs. It's usually because the volatility in the further leg is already higher, right? And so yeah, can it go even higher? Yeah, that creates the risk, but it's absolutely limited. If you'll take a look at the I think it's the last report, maybe the report before that. There is risk, and there is risk that the maximum projected loss is a little bit bigger, but it is absolutely limited, and it's usually not that much bigger. And so it's a lower probability of that happening. Let's see. Can option insanity trades be identified without PDS Trader? It's very difficult because it helps you. I mean, there's just so many different combinations, right? And so that's why I had PDS Trader created way back when, is because it just takes too long to find these opportunities otherwise. And so very, very, I mean, why not use technology to help find the right best opportunities? Let's see here. I entered a risk-free trade like this one. Oh, great, excellent. Is the idea to close out the near-term option when the spread expires? Yes. Dawn, so the signals will be moving to Trade Partner, but there is a free version of Trade Partner, so you can still get the signals through Trade Partner. You just won't be able to take the trades through Trade Partner. And it's because I'm doing too much work, to be just completely blunt with you. First, I put everything together in Trade Partner to begin with. Then I have to transfer all of that information and redo it in PDS Trader. And it's getting to where, I do so much. It's a higher margin for error because it's done twice, not once. Takes so much stinking time to make the transfer. So that's why the signals are moving to Trade Partner, but it doesn't cost you anything else because you're going to have a free version of Trade Partner. You can still access the signals, even if you don't make the trades through Trade Partner. So you're not making the trades through PDS Trader right now, so it's absolutely no difference whatsoever. Let's see. How do you exit the options you sell if they are, excuse me, in the money? usually on a spread with target with the longs. Usually you predict a decrease in IV based on your own situation. Is it fair to consider a decrease of 30% or so? So what I do, so PDS Trader, I had PDS Trader created so that you can change the volatility settings. And so what I'd like to do is, for example, I know that the average Monday at the money option on a Friday at the close, if the volatility comes down, is going to be priced at about 70 cents. It's just, again, something I know, something you'll become familiar with as we go through this, and I'll reference that more often, uh, uh, more in the future. But what I'll do is I'll adjust the volatility in PDS Trader to reflect a closing price of 70 cents to get a more accurate idea of what a volatility drop is going to do to the spread. And that's what I did here in the in what you see. And if it drops even more than that, then obviously I can do it to where I drop it more than that. And I can say, okay, if it really tanks, I mean, if they really just crater the volatility on Friday, what's my worst case scenario? Um, and so then I can decide, okay, yeah, it's worth taking the risk or it's not. All right. Again, PDS Trader tremendous for doing that. Do you plan to provide signals for SPX? No, because I'm doing too much as it is. We go deeper into the reverse ATM calendar value that dipped. Ian, that was just kind of a telltale. I will go more into other spreads, not the reverse calendar spread necessarily, because that's not one that I normally trade. But very similar to that would be a diagonal spread where I buy let's say a 295 and sell a 295.50. So it's very close, but I'm selling the 295.50 further expiration, and I actually create a credit on that, and that creates profit to the upside, profit to the downside, and a small risk in the middle. So yeah, I'll be going much deeper into those types of relationships. How do you project the debit or credit for a specific trade that will be placed on the next day? I base it on a market movement projection and a volatility drop projection or increase projection, whatever the case may be. And I'll go into that further in more details, but what you can do is you can look at, let's say you want to look at the variations between the spread that I just gave, a 295 and a 295.50. All right, buy the 295, sell the 295.50. Option insanity setup where you're selling the further expiration. We'll look at the 295.50, 296. Look at the 296, 296.50. Look at the 297, 297.50. You'll get an idea of how the prices move based on a move in the market. And so if it's the 295, 295.50 is at the money, and then the market moves up to 297, 297.50, then I can project that the 297, 297.50 will probably be priced somewhere close to where the current 295, 295.50 is. All right, again, I don't want to get too far into that, but that's a real quick explanation of that. Margin on a 20 trade would be 20 times 150. Not on this one, no. It's so on this trade, it's 20 would be 20 times 6. All right. On this one, it's basically a 16 times 6 plus a 4 times 150 scenario. All right, let's see here. The dynamics graph of relative option prices for different expirations available. So Steve, I believe, let me see if this is the one you're talking about. Is that the one you're talking about? And that is one with 3 different ones. And so that's created in PDS Trader. And all you have to do is create a group. And then in each group, change the volatility in the long leg of the group. And you'll get the different prices. All right, so that's that one. And this one is available in Trade Partner. All right, so whichever one you're on, both of them are available. One in PDS Trader, the other in Trade Partner. It's a wonderful way to live off trading. Yep, as long as you don't try and do too much. That's where people get into trouble, is trying to do too much. That's why I say start with one trade from like 3 different strategies. Yeah, do a cash flow 1 trade a week. Do an option insanity 1 trade a week. Do an RFP 1 trade a week, and don't do any more than that. And really get to understanding these trades, and then you'll start to see your account grow. Will you show how to manipulate the trades? Peter, that's actually so yeah. In a way, I'll show how to manipulate the trades within the option insanity, because you have to manipulate everything. You have to create what you want. So, and either it's available or it's not. But the way you manipulate, same principles, but just slightly different. How should I say it? Strategy for manipulating a normal PPD trade, such as the one that I showed you today. So the answer is yes in part and no in part. When will smart trades be available on Trade Partner? I'm not quite sure what your question is, Carter. When will smart trade be available on Trade Partner? Can you clarify what you're asking there? Do you manually close your trades just before the market close on expiration day? So you can manually close. I use Trade Partner often. I often use Trade Partner. Again, I know you've seen me and heard me talk about Trade Partner. You're probably getting sick of it, but I'm telling you, all of these things I create because I need them as a trader. And if I need them, I know you need them. And so Trade Partner allows me to use it to exit these trades because I have a lot of trades, especially because I have a lot of trades. And when most of them are expiring at the same time and you have to get out at the same time, it can be ridiculous. So Trade Partner is what I use most of the time. How much is Trade Partner? You don't need to invest in Trade Partner as well. You do not need to invest in Trade Partner. You get the signals through PDS Trader. You get the reports through PDS Trader. You can put the trades together through PDS Trader. Trade Partner is simply a much easier way to actually execute the trades. All right, so plan and execute the trades through Trade Partner so that you don't have to do it with whatever, with your broker or whatever, through your broker platform at the time. But it's not necessary. If we find opportunities, can you give us an example of placing and choosing strikes from beginning to end in the next session, please? We'll get there. We will get there. All right, somebody just got filled on the trade that I gave. Now, okay, as long as y'all know, A lot of y'all took the trade. Just understand that there is risk. Don't go too big. Can you please review what we get with this course? I think you mentioned a compounding and something. Patrick, so the compounding is actually in the last session. Right, so I covered the compounding in the last session. I did not include that in this program with regard to any of the marketing, but I am including it as a bonus. So it will be covered because I do that with all of my program, all of my strategies. I didn't market it that way, but I am including it. Again, Christian, you can use this strategy in Thinkorswim. Again, you don't need trade partner. Further, trade partner, by the way, will be hooked up to TD Ameritrade. We're actually testing that as we speak, so that will be available on TD Ameritrade very, very soon. Again, on the option insanity, the spread is exited at the same time. I do not hold a short naked. Joe, if you don't see it listed, in the system strategy, it's not there yet. We had a glitch, so I had to remove it, and they're fixing the glitch, and then we go from there. Ryan, you, sir, are a genius. No, no, I'm actually not. I just spend a lot of stinking time looking at this stuff. So, and where do we get access to Trade Partner, the free account? Patrick, you will get instructions on that probably tomorrow, maybe Thursday. Don't worry, we'll give you plenty of time to get hooked up with that. Nice presentation. Excited to see the next session. Great, thanks. Appreciate it. Should we be using Beta Trade Partner? Tom, absolutely. That is what I use. Please show the smaller trade size money expirations again. All right. I assume you're talking about the trade that I took today. There it is. And people have already chimed in and said they took this trade while we're in session here and got a debit of 5 cents on this. So, again, if the market tanks, you're going to lose $5. It's probably not going to move up to where you'll lose $5, but if it tanks, you'll lose $5. And if volatility really craters, you might lose $5 in the middle. So smart fills are, Guido, they're already up on Trade Partner. We just have not advertised them yet. So it's for the discerning user, and as soon as I upload the videos for it, that's when we'll kind of make the announcement. But just letting you know it's already there. Let's see here. That smart trade is something that finds the. Oh, okay, Carter. So the trade finder, and yes, that is again. That's something that'll be in PDS Trader. The system strategy will be option insanity. It will show various trades available. And again, I had a glitch in it in creating one of them. And so they're taking care of that. And then that'll be back up again, hopefully within the next day or so. Trade Partner right now works with Tradeer. We're testing it with TD Ameritrade right now, and then next up will be IB. IB, they've been a pain in the butt to work with, just to be blunt. I am new and a little lost how to make a new trade with this method. Jim, be patient. If you're brand new, if this is the first time, that's kind of why I went over this today. I realize my approach, the way that I approach this is different than what anybody else does in the industry. I realize that, but I promise you it's much simpler, um, because I'm just not that smart, and so I have to create simple ways to understand things. Trust me, it's just a matter of exposure. You'll get it, light will click, and it is worth it. Um, and these guys, a lot of these guys who have been with me for a while, they'll testify that it is worth it. It's not the Holy Grail, doesn't exist, but you can come. I mean, look, I mean, how many times can you place this trade on? When this trade that I'm showing you right now here is available, how many times do you think you'll be able to place this trade on and make something on it? Most of the time, right? How many times are you going to place this trade on and actually lose $5? Right? Not often. So we go with high probability. And that's what I'm trying to provide with these different opportunities is the way to go high probability, low risk. Is there a mobile version of Trade Partner? Not yet. You can use Trade Partner on your phone. I have. It's not exactly the friendliest, but not yet, but soon. Have you had experience doing these trades via Trade Partner through Tradeer? Yeah, that's all I do. I do place a few through IB just to compare fills, compare commissions, et cetera, et cetera. But most everything is done through Tradeer and Trade Partner. Greg, I hope session 3 is really something because all of this is clear as mud to me now. What should I study in the meantime? So I'm not going to suggest that you necessarily study anything except maybe go to resources and watch my PPD video and watch it as many times as you possibly can until you understand the variation of PPD. But outside of that, I'm going to say patience. All right. It will click. It will click. So again, I know it's brand new, different type of approach, but it's worth taking the time. Absolutely worth taking time. Otherwise, my suggestion is unfortunately, there are a lot of traders who think that you can just begin to trade and because you're successful in other things, a doctor, a lawyer, whatever, airline pilot, you're successful in all that you shouldn't need to do anything to be successful in this, and that's just simply not true. It's going to take patience. You're going to have to take the time to learn, but it is worth it. If you don't, you're going to pay for it. That I can promise you. You don't take the time to learn it, you're going to pay for it because the markets will make you pay. Okay. Somebody got filled on that trade at a 4-cent debit. All right. So, Harry, to get the special pricing deal with Tradeer, tell them that you are a Trade Partner customer. That's how you get the Trade Partner. Mention my name, Ryan Jones. They'll give you the deal. I appreciate that, Guido. There will be more interesting opportunities when daily SPY options come on board. Unfortunately, we don't need to worry about that just yet. Oh, smart fills is what you meant, Carter. It's already up there. We haven't publicized that it's available. And so I'll be talking about that in a video soon. And he was talking about Trade Partner there. No, Harry. There's no promotion. There's no special code. Just mention my name. Carter, great. Thanks for the great presentation. You are welcome, Carter. Appreciate that. Do you know that Tradeer does not allow offsets in your covered calls program? Yes, Skip. That is one negative with regard to Tradeer, is that the offset will cost you $9, but it's $9 per trade. So if you're a bigger trade size, it's no big deal. Um, it costs, if you're in a 10 lot, it's less than $1 if you offset it. Otherwise, you need to offset beforehand so you don't get charged that $9. But yes, I am aware of that. Thank you. Uh, expire. It's critical to close all positions at the same time, not just before the short option expires. At the same time. But 6344 customs by 120 Another Ian. Okay, Ian. So you got filled on a different tribe. Excellent. Greg, you are quite welcome. And again, if at the end, as we get through this, if you have questions, believe me, I will go through as many of these sessions as is necessary to make sure everybody understands. All right. All right. Looks like I got all the questions. Man, that was a lot of questions. I appreciate it. It's good stuff. And I will see you next time. Look for the next schedule session on the Option Insanity updates. It'll be posted there just like this one was. And I will see you next time.